back to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Today, we are lifting the lid on one of the most polarising corners of the property world, new property. For a lot of investors, that phrase immediately conjures up images of spruikers, inflated prices, and glossy brochures that look better than the eventual returns. My guest today sits right in the middle of that space and spends most of his time trying to clean it up. Richard Crabb is the Vice Chair of the Property Investment Professionals of Australia and the CEO of Aspire Property Advisor Network. He's a property investment advisor who leads with strategy and planning first and treats the property itself as the last step in the process rather than the starting point. In this conversation, we dig into what proper property investment advice actually looks like, how his review and planning process works in practice, and why most investors have far more clarity about what they like than what they actually need. We talk about the advantages of quality new property, where the real risks sit, how to spot oversupplied location, and the key data points Richard leans on, such as owner-occupier ratios and population catchments. If you have ever said to yourself that you should never buy new, or you are quietly curious about whether there is a way to do it without getting burned, then this episode is perfectly for you. Here's Richard. Richard Crabb, thanks for joining me on Geared for Growth.
Thanks for having us today, Mike.
Now, as no doubt I will have shared in the intro, you are the Vice Chair of Pippa and CEO of Aspire. Starting with Pippa, we met when I joined the Pippa board, which was a lovely little upside I didn't realise. I've come to really know and respect you, Richard. So I want to know what your passion is behind Pippa and what Pippa means for you.
I joined Pippa coming on about 9 years. I think I'm coming up to 9 years on the board. And it was actually Ben Kingsley, the prior chair of Pippa, had been speaking with Ben about what our business model is and what we do, which is in the new property space. And at that time, Ben invited me to join the board. Once we showed him our model and how we structure and do it, that new property, there is a space for it. There is a lot of out there that do it the wrong way. And when Ben sort of saw what we were doing, that's when it brought me to bring on. And that's what we've been passionate about is, having people doing professional property investment advice, but with the best interest duty of care, which is what Pippa's all about.
So when you talk about property investment advice, obviously the listeners are quite familiar with buyer's agents, but how would you differentiate a typical buyer's agent to someone that's actually providing property investment advice?
Look, there's a time and a place for both. I guess the difference with a property investment advisor, it's really about going back to the strategy first, and the property being the last part of the process. Often a buyer's agent will work with an investor on a brief, where the investor's driving the brief more than the buyer's agent. Then the buyer's agent will normally look to fulfill that and provide the client the brief that they've requested. A property investment advisor works the other way, and the property becomes the last part of the process, and also removing a bit more emotion out of it. So probably if you break it down into 3 key steps, it'd be review, plan, act, and review. So really 4.
So I'm interested in that because I would argue that the buyer themselves or the investor, they might know what they like, but they might not necessarily know what they need. And how do you actually know what you need without doing the planning piece? I mean, I've said over and over again on this show that the planning and what you're trying to achieve is the veggies, and then the property is the dessert. And mum and dad always said, you got to eat your veggies before you have the dessert. Do you feel like that advisory piece is actually a big missing part of the strategy of a lot of investors?
A big thing, and that's what we see the most common mistakes that investors make is bringing emotion into it, acting without a plan, listening to the noise. And it's the old Stephen Covey. You've got to begin with the end in mind. What's the exit strategy? Or free advice is the most expensive advice you'll ever receive. And there's so much noise with the influencers, the social media, the marketing, and they're doing exactly that, which is spending marketing on marketing to connect with you, on a emotional level to buy something that they're selling.
And that marketing has resulted in Macquarie adjusting their trust lending and APRA as recent as yesterday at the time of recording, limiting the debt to income ratio, or at least sort of changing some of the rules around there. So we can definitely thank some of the Facebook marketing for some of those changes, I would assume. But let's talk about somebody that's, say, referred to you. They're a family friend, and they're like, Richard, I want to invest in property because I see the market's going up and I want to sort of, have a good financial future. When you sort of sit down with them, do they often have an idea of what that actually means in real terms, i.e. when I get to 60, I want a 200K passive income, or I want to have a super balance of X when I retire? How sophisticated are people's thoughts when it comes to that end goal?
It's really a challenging question that we do ask people up front. And that, I guess, is the difference with a property investment advisor versus someone who's trying to sell you something, is we actually go back and unpack that. So starting with that understanding of where a client's at is so critical. And sometimes it's having the conversations with them that what they think they want isn't achievable, or looking at how they can get to that. So a part of that process of unpacking where they are today, where they want to be. So looking at that time frame. So if someone's in their 30s and they're going to retire, their plan is to retire at 60. Well, you've got a 30-year time frame with that you can look to pay debt off. You can look to have passive income. And it really is helping people understand what's achievable. And with property, it is a longer term approach, but you've got to get the structure right. And it's not just about the property, it's about buying an asset that you're going to structure correctly that will align with your time frame and what you actually want to achieve.
So can you describe in sort of, I suppose we've only got a short amount of time here, but how that sort of process works? So you sit down with the client, you're asking them, okay, well, what are you trying to achieve? Obviously, you need to understand their borrowing capacity, their risk appetites, but what do those sort of inputs look like that lead you into the direction of, okay, well, you would need this type of property, or this is the direction that you need to go in?
Yeah, so the first thing we start with is where they are today. So we do a detailed online questionnaire through our platform to really get their information of today. So looking at what properties they may already own, what's their income, what tax brackets are they in, what's their savings, what's their expenses. So the surplus income is an important one because that can then tie in with what's going to be achievable. And you really need to unpack exactly where they are, and we've got a very detailed questionnaire to do that. That then helps us debrief with them on their goals. So once they filled in that questionnaire, a big part of it is, well, what do you want to achieve? Is it an income goal? There's really two things with property investment that you can achieve. It's passive income or generational wealth. And then it's unpacking, how do you want that to look in at retirement, or what's your plan? Are you buying an asset that you want for passive income? And if that's the case, well, we've got to pay the debt off. Do you still have an owner-occupier debt? Well, let's maybe focus on getting rid of the bad debt and good debt, bad debt conversation. So can you pay off your home and pay off an investment property based on your income and fortnightly payments and making sure structures are right? So it's the modeling and the numbers is what we focus on. And it's normally a couple of strategy sessions we find with a client to make sure they understand the real numbers.
Yep.
And we break into that modeling side of it to make sure that people actually know the numbers. So if you buy a property for X, this is the cost to buy it. This is the tax benefits. This is the income. This is the running costs. This is what your actual out of pocket's going to be. And then tying it back into that. So it's understanding today, knowing what their end goal is, and then working backwards from there to show them all how is that achievable.
Yep. I think it's fair to say, like you mentioned before, that your average buyer's agent is brief focused. Okay, the investor, they always want the same sort of thing. I want, sub 600,000, 20% growth in the first year, 5.5% yield, newer, lower maintenance in a blue chip location, right? They're all looking kind of for a unicorn, but there would be some buyers agents, I assume, that would take issue and say, well, no, like we do the planning and we do the strategy stuff as well. But I'm interested in that space. Are there any regulations? Are there any qualifications that people have to check off or have certified to be able to provide that advice? Because we did talk about, the online sort of Facebook finfluencer advice. Is there any way to differentiate proper, robust, qualified advice?
Look, definitely. And there's a couple of key things that you should be looking for with anybody you deal with. If they're giving property investment advice, not biased because I'm on the board, but the PIPA QPIA is a very good fundamental course. We make it a mandatory requirement for any of our property advisors. So because it's understanding what are their qualifications. So one is the QPIA. Two, whether they're a buyer's agent or a property investment advisor, do they hold a real estate license? Then, and also, do they have professional indemnity insurance? So property investment advice is an unregulated space. So unfortunately, you can go to Microsoft Word and print a sign that says I'm a property investment advisor and put it on the door and off you go. So those couple of key ones is, do they have professional indemnity insurance? So to have that, they'll need to have a proven no conflict of interest for the underwriters to approve that. Do they have qualifications such as the QPIA and holding a real estate license, even though they may not be selling property? Even as a buyer's agent, you're supposed to hold a real estate license with that government body in the state that you're operating in. So yes, they're probably the key ones. And then also asking the question, are they an investor themselves?
Yep.
What's their experience? It's getting advice from people who've got that experience and actually doing it themselves, as well as the professional qualifications.
Yeah. Thanks for clarifying that. Now, you mentioned in the beginning that you focus on new property. Now, presumably, with all of the planning piece and putting all the pieces together, understanding where they're at and where they can go, you could do that with established property, but you work in the new space. So what is it about new property that you see as having an advantage over established?
So if you think of brand new, there's good and bad in both. And it's about getting the strategy right and the asset right. The quality of the asset is what matters. If I think of some of the reasons why we focus on new, probably some of the biggest advantages, depreciation is one, which can really help that cash position early on, especially in the early years, because you're able to write off the fixtures and fittings. So it can help towards getting those extra offsets on your cash flow. Yep. Lower maintenance and capital expenditure. Investors avoid the unforeseen spend. Yeah. Because it's brand new, it has warranties, they know the quality of what they're getting. They're not inheriting someone else's issues. We also see tenant appeal. So tenants love new shiny things. Having a newer home, more, and also lower vacancies, better rental returns. Also then ties in with the compliance, because brand new properties have to be 7-star energy rating and be up to all the modern standards. And also easier to manage and budget. So it's really more of a data-driven decision on new property. But again, it's also really important to make sure the data stacks up and the property, is the right. So I guess new property gives you a head start in your cash flow, but it's not a free pass on due diligence. You've got to be very careful when navigating brand new, and it is an ability to buy that more of a set and forget, but you've got to be really investing the time up front to make sure that it is the right property.
Yes, because you could buy the wrong established as well as the wrong new property, right? And, the repairs and maintenance things, there might be people listening going, oh, Richard, they're all tax deductible, but you've got to have the bloody money to pay for it in the first place. And honestly, it's bad timing for me after having a property with some rather severe expenses that's very established, I would say. You mentioned the new, the shiny. there would be people maybe listening and going, oh yeah, well that's all good, but it only gets to be new and shiny once. And I suppose they would use the analogy of the car driving off the lot. You know, you're paying a premium for that new, but it only sort of happens in the short term. Does that analogy work in property, do you think?
I guess I'll tie it in with that analogy. Existing properties is like buying a used car. You can see it, you can touch it, it's got a service history, so you can sort of see all those things.
Yep.
You know, new property is like a brand new car. It smells nice, it has a warranty, but you've got to be careful not to overpay in the showroom. You know,
Yes.
and if it comes down to, if you get the strategy right and buy an investment grade asset, you'll care a lot less in 20 years whether it was brand new or 10 years old when you bought it. So in both camps, old or new, it's make sure the asset that you buy is the right quality of asset, but most importantly also aligns with what your specific strategy is.
Yep. If we stick with that car analogy, and in some respects it doesn't work, because I learned a couple of years ago the margin on new cars, at least in Audi dealerships, was ridiculously small. However, I feel like in new property there is an opportunity for margins to be huge, and that's the bad press that we hear time and time again, right? And I'm sure as a professional with ethics such as you have, you are sick of being speaker one for the negative of, you know, new property is only where spruikers transact. And we've all heard those stories, and I've seen the emails of, you know, a $30,000, $40,000, $60,000 commission for me to introduce some of our clients into properties, and you know that definitely gives new property a bad name. How do you typically respond when people are coming at you with that? Because I'm sure you've had some degree of hate mail over bad experience that have happened elsewhere.
I'll start with a couple of, if I say sort of two things, and I'll unpack that a little bit. So new and shiny in the wrong street is still the wrong investment. You know, and then, you know, if anybody, you know, when you're looking at it, if the brochure looks like everyone buying it is an investor, you know, be careful you're not buying in an oversupplied area. So, look, some of the biggest risks and downside of new property is exactly what you were saying. There are a lot of players out there that will load significant amount of fees, quite often in big upfront commissions that they're paying salespeople to sell. So that development margin and pricing, you know, to really make sure that you're not paying a marketing premium. And look, we've seen instances with, like what you said, builders or developers saying, yep, we're selling it for X, you can add on whatever you want to charge.
Yep.
And we've seen instances of people adding 60, 70, 80,000. The worst one I've seen is 95,000.
Wow.
So property worth at the time maybe 500, but the investor was sold it for 595.
And there's no legal recourse, right? And that is actually a legal, I mean, it's a predatory practice, you could argue, but it's not an illegal practice.
Yeah. Unfortunately, it's not. And this is where, again, avoiding the marketing and the very slick marketers. And there's some very big operations out there that will tell people everything they want to hear and manipulate them on it, and then have offsets there where they'll use their equity to cover any shortfalls with bank valuations, etc. You know, and this is where unpacking, you know, when you're looking at an asset, you know, you've really got to assess with brand new, okay, is it actually correctly priced in the market? You know, so compare it to similar completed stock in that location, you know, not just off the plan sales. The wrong location or product, you've got to, if you're buying brand new, you've got to really look into the data. So especially if it's a greenfield estates where, again, a lot of these marketers have big, massive stock list of hundreds and hundreds of properties that they want to sell. Yes, they're brand new and they're shiny, but there's no scarcity.
That was definitely a question that I wanted to lean into, because I've sort of been criticised by guests in the past to say, like, that I take the stance that units are terrible and off the plan is terrible, because we often just focus on the bad stories, right? When I talk about units, in my head, I'm thinking about units in a complex of 400, right? And that, I haven't seen any evidence yet that one of those is going to be a great investment as a brand new asset. And when I'm thinking about new, I suppose I do focus on the horror stories. But when I think about new builds, I am typically thinking about these greenfield estates. And it kind of begs the question that if that land was created for a dwelling to be built, then it's probably in an area where there is more land. But of course, there are infill properties as well. So how do you sort of compare the two? And if you are looking in, a new subdivision, and I'm not sure if you do, but if you do, what are some of the risks that you're looking at in terms of that? You want that scarcity to be baked in as much as possible, right? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, and look, there's a couple of key ones that we start with, and then we'll drill down further. But, when you're looking at a housing location, there's really two questions you want to ask yourself. Is, firstly, who's going to be my tenant? And then that gets into the demographics, the socioeconomic, their income levels, employment, their education levels. So, and then the second question you've got to ask yourself is, when I do want to sell it, who's going to want to buy it? And a good example with that is one of the high level statistics that we'll always start with is, what's the owner occupied or renter ratio? Are you buying into if it's a high renter to owner occ, so let's say it's 40%, 50% renter in a housing location, that's a real red flag. We use the maximum of around 30% is a maximum. We're really looking at that, 80-20 or so 80% of people are buying there to live, because that's again going to drive up prices.
Yep.
Because that if they're buying there just to rent, you see that either higher vacancies, you see, a different demographic, and if people aren't buying there to live, that's what's going to have a greater impact on capital growth in the long term. And when you're buying new, you're buying in these emerging locations that are going to give you the benefit of capital growth. But if you go into one where there is that too many renters, that you've really got to understand why, and buying those locations that are going to give you a better potential.
So in our own data, we know that if an investor purchases a property and they occupy it for a period of time first, they actually spend on average more on improvements and renovations, right? So that kind of makes the case that if it's a higher proportion of owner occupiers, then that suburb will kind of gentrify or refresh. There'll be more renovations. The houses are all kind of pulling upwards together in price because they're renewing and refreshing. So that's obviously an example where a higher renter ratio is a negative. But in terms of other negatives, you mentioned, vacancy, because there's more stock available. But when you're looking at, let's say a new subdivision that hasn't had those transactions yet, are there ways that you can tell, like, this is going to have owner occupier appeal, or do you only go in areas where that data is already kind of available to you?
A bit of both. There is a lot of, there is data out there, and the marketers will tell you what you want to hear.
Yep.
It's about really unpacking what does that look like. So in a real greenfields estate, you've got to be very careful to understand it, because if there isn't the data there, you've got to be able to unpack, well, what's it going to look like in the future. In some of the emerging locations, you might have some of that data with what's going to happen in the future, especially around employment. So it's also looking at population densities. So another, high level metric that we use is, you're always looking at 100. We look for at least 100,000 people within a 20K radius.
Right.
So again, if you go into a regional location where there's 18,000 people, your boom and bust or your potential for growth, the property might be cheaper, but then the future potential, if the current population is at 18,000, you don't have that critical mass of infrastructure, employment. You might have one big employer like a mine or something like that.
Yes.
So we sort of, so if you are buying in an emerging location, then you've got to look at, okay, well, where's it? What's the land look like?
Yep.
And I'll give you an example of one going back to 2016. So I'll go back in time. We had investors buy in Ocean. We had some investors buy in Ocean Grove. Now, at the time, that was an emerging suburb. But it was predominantly owner occupier from the surrounding section. It was just under the 100,000 within 20 k's.
Yep.
But 50% of that 20k radius, the tenants were dolphins. So seaside location. So there was some reasons, but then there was also landlock. So yes, there was some new land available in a housing estate in Ocean Grove, but it's a desirable location, seaside, lots of employment drivers. People in Geelong would rather live in Ocean Grove or travel. But the biggest thing there was the scarcity of land in the future.
Right.
Because there was a landlock overlay that, yes, there was land available, and we saw land go up consistently and had consistent growth in that time. From 2016 till now, we've had significant, well above the 7 or 8% national average for housing. It's exceeded those percentages. But then you look at some of the locations in other locations in Melbourne where there's land that can be developed as far as the eye can see.
Yes.
So it's that comes back to that unpacking that, the bigger picture, around. And again, it comes back to scarcity, supply and demand. Why will people want to live there? So where are they working? What's the economic drivers? What's the future infrastructure that's going in? Is there a train line opening up? Is it what's going to drive that growth in the future?
We had a guest many moons ago now, I suppose, that was in the new space, and they talked about something called mechanical momentum, where there were land releases that were happening in stages. And of course, a developer wants to constrain things as much as possible, rather than going, here's the 400 lots, you guys fight over them, because that's not great for sales. They'll release it in stages. And they actually found a strategy where at the right time, purchasing early, they can actually build that kind of growth as the demand sort of increases, and they're staging that release. They also had a competitive upside where if they were doing a certain amount of volume, they were able to negotiate with the developer. I'm wondering, what are the differences with, say, me going and buying a brand new property to someone like yourself that has that network and the connections? Because I know a buyer's agent would talk about, well, we have relationships, so we get access to off markets. I'm wondering what the new equivalent is.
Yeah, so for us, we tap into a national acquisitions team. So part of what our network has created is that, in a sense, a buyer's advocacy team, but specifically on new. And they've built relationships and networks. But again, we have a very long list of who we won't deal with, and a very short list of people and that we will deal with. And they use that to then tap in to navigate again through the noise. A good example is like what you mentioned before. We get bombarded, as a property investment advisory organisation, we get bombarded by stock lists and massive lists of all these properties that we can sell. That in itself is a red flag for us, because we don't want to be helping clients buy a property where there's 400 pieces of stock that the people are trying to sell. And so it's sort of unpacking past as you said, we put any brochures go in the bin. That's the first thing that we do. And if we know there's a huge amount of stock getting promoted to investors, we won't go there. And
that affects the ratio too, right? Because if they're marketing to investors, then that, okay, well, this could be a little hamlet where it's got an 80% investor ratio.
Well, and we've seen that. Like there's locations out there that are predominantly, it's just being used by the marketers and the spruikers to sell stock. And they'll build a beautiful story around it, and they'll tell you all the great data and all the great research of why you should buy there. And quite often, we see like something, again, we're national, so we're not pigeonholed to one location, but then you might have an investor in Sydney going, oh my God, this is so cheap. And I get a big house and look at all these amazing reasons to buy it. And because in Sydney, I could never get anything for that. So, they've gone and spent money on something that looks cheap, but in reality, it was actually very expensive.
Yes. And on that question, in terms of cheap, there would be people arguing that we're at a point in the cycle where the differential between established and new is quite big, because whilst we know construction costs are only growing at their sort of pre-pandemic levels, construction costs aren't necessarily the problem. We have labour shortages, which is a problem, but that's another episode.
Yep.
But we did see around about a 30% growth in construction costs during the pandemic. So there would be those that were kind of saying, well, new is actually just a little bit too expensive at the moment compared to established because of those construction costs. Do you feel like there is a bit of an elastic band where, the new build can be a little bit expensive, but then the established kind of catches up? And where do you think we are in that cycle? And is that a reasonable argument against new?
So there's probably three myths with that I can probably answer that question with. And it's not always new versus old. It's investment grade versus everything else. And the trap that we've seen with some investors, is they've gone and bought the wrong asset in the wrong location, or they're thinking that they're going to renovate it and improve it, and then they thought it was going to cost them X amount to renovate it and improve it, and it ends up costing Y, being a lot more. Or the time to organise trades for renovation. We've seen a lot of people who used to flip properties being caught out because they were buying to flip, which used to work, but then the cost for them to renovate or upgrade it or come up to the minimum standards now with some of the rental reforms where you have to be at a certain compliance level.
Yes.
All of a sudden, you're generating yield from a property and your profits and your capital growth. The yield's helping to pay for it as you go along. But you're wanting that capital growth. But if your capital growth is getting eroded because you're having to invest more and more, so yes, construction costs have gone up, but when you buy a new property, at least that's fixed. And at the time, and you can assess, is that where it should be in the market? Is it priced correctly?
Yep.
So,
I suppose you're comparing it to what's established there, and okay, there are more benefits to new in terms of the warranty periods and the defects liabilities, and then the rental premium. And if the market is dictating that that's a price worth paying, then the deal stacks. But otherwise, it doesn't. I was taken by that point. What's less important, that I think that we as humans like to put things in boxes, new versus established, house versus unit. Well, the local economy and the affordability and the local jobs and the infrastructure development and the town planning have a much larger bearing than those little boxes, right?
Yeah. And I'll sum that one up, if I can, with three simple myths. If you go at the new versus existing. So firstly, is new property overpriced? In reality, sometimes absolutely. Especially if it's developer stock that they're just trying to sell through seminars and marketing. But well-researched, boutique, infill, and correctly priced in the market can outperform because you know your costs and that future planning.
Yep.
A second one is probably, we always hear is, existing property always has better capital growth. But in reality, it's not. Because growth is driven by land scarcity, demand, wages, infrastructure, not just the age of the building. New and a constrained infill location can outperform an older existing property in a fringe estate. And then, look, the third one, you can't add value to new property. In reality, you can at future stage do minor upgrades, but your capital investment in a new property is ultimately normally a lot less from a capital aspect than what you're going to take out for in existing.
Yeah. And I wanted to ask, in terms of, we talked about how transactions happen in a negative way in the new space. A developer might have a stock list going, I don't care what you guys can flog it for, give us this and the deal's done. You can also have people charging a fee to purchase a new property for you, and then also getting a developer kickback, which of course needs to be disclosed. I think we've seen evidence of when that isn't disclosed. But how should things work in the new property space? If somebody is in the process and going down that path, what are the red flags that they need to look out for?
It's working for both sides of the fence. So, the biggest one we see, which is what we put a lot of time and infrastructure into avoiding, is if they're charging a client a fee, they can't be receiving, or having a commercial relationship with a vendor, developer, builder, seller, whatever.
Yep.
And that's one of the way that we sort of overcame that. And this is one of the big questions to ask people, is that property that you're recommending, is there a commercial relationship there?
Yep.
The way that we've gone about it, well, our model's been very different. We disclose for one.
Yep.
Our advisors will normally charge a fee for service up front, because the client engages the property investment advisor to work for them.
Yep.
That property advisor has their best interest duty of care. Then what we'll do is then Aspire, who actually goes and negotiates and finds properties, they hold the commercial relationship. So even though our property investment advisors have full real estate licenses and everything else, they're not allowed to have a commercial relationship with any vendor, builder, developer, seller.
Right.
So
there's an arm's length there.
Yeah, and because we use a compliance platform, so everything has to go through our platform. So the way we work is we do tap into. So if you are buying a property, whether it's existing or brand new, the person selling that property. So if I went to realestatettoday.com today and bought a property for $800,000, and I'm happy with that. I'm happy with that price in the market, and that's what I'm buying it for. The person selling that property at 800, out of that 800, they have to pay their real estate agent.
Yep.
For and any marketing that they've done, whether it's realestate.com or brochures or newspaper or everything else.
Yep.
So where we're different with what we've done and what we fully disclose is Aspire will hold any commercial relationships, because Aspire isn't working for the client.
Yep.
So when the Aspire acquisitions teams, sources a property based on the buyer's brief, so our advisors will create a strategy and a plan, which is what they've paid for the time to produce. Once they've got that plan, they know all those elements for the strategy, the asset, the budget, the risk profile, the stress testing. They put all that together. They'll then give the brief to the acquisitions team. Well, here's the strategy, here's the budget, here's the brief. They will then go and source 1, 2, 3 properties, depending on the brief and how specific it is. And it could be in different states. Here's one in Vic, here's one in WA, and here's one in Queensland. And they'll then secure those properties for a property advisor, who will then explain, go through that data with the client to make sure that it's meets the budget expectations and is actually worth, like we said before, it's not overpriced and is correctly priced. So that, and then yes, out of that vendor's fee that Aspire paid, they'll pay out the balance of the fee onto the advisor. But again, our platform discloses all that up front.
Yep.
So there's, and look, we've been disclosing since 2016 commissions, and again, in this space, you don't need to disclose.
Yeah. Which, I mean, that shouldn't make you a trail breaker, but it does, unfortunately, right?
Yeah.
But that's the key. Like, you just want to know the moving parts. Okay, well, if you're working with someone and it's a new property, especially if you're not paying a fee for advice, you need to understand, okay, well, they are getting this from the developer or the builder. That doesn't necessarily have to be a bad thing because it's disclosed, but with that fee baked in, is the deal still a good deal?
Yeah, and that's the biggest difference. It's transparency. We, again, part of, I guess where we're different with that is it is that long-term relationship with the client, not a churn and burn.
Yep.
That it's everything's up front as explained, how we're structured, how they work, how everything's paid. Then when monies are paid, it's our platform produces a disclosure document, so it's automatic. It can't be not disclosed. But again, we've been doing it. I know it sounds trail breaking, and it should be the way it's done, but it's and this is where using both technology and transparency, and having that compliance platform there that tracks every document, every communication. The client gets a login, the advisor working with the client tracks everything. So it helps with that consistency, that genuinely when the advisor and the client look at an asset, is that asset priced where it's supposed to be? Is it at the right price in the market, not loaded with extra fees? And will that deliver the returns that I want for the future?
Yeah, I love that. And Richard, I want to say a big thank you for lifting the lid on how things can work, should work, and shouldn't work, more importantly, and also being a good sport for some of the chin music I was trying to give you about new being dodgy or, less performing than established. You've busted some myths and shared some really good advice there, so really appreciate it.
Awesome. Well, thank you for having us today and unpacking that. There's some good and bad in every industry.
Absolutely. Couldn't agree more. Cheers, mate.
Thanks, mate. Thanks, Mike.